This is the video demonstration on partnerships, and in this video I'm going to work the solution to example number 10. This example involves the Justice Company, which was formed as a partnership on January 1st, and they had the following transactions that occurred throughout the first year of operations. And we have a whole series of different transactions. And under the requirements, we are required to prepare the necessary journal entries. Now, anytime we have a partnership, remember we need to have a separate capital account for each partner. And we're going to be using these capital accounts quite a bit to do these journal entries. So the first transaction is on January the 1st. On this date, the partnership is formed. We have a partner here named Smith, who is contributing $100,000 cash, and then we have a second partner named Jones, who contributes $10,000 cash, a building worth $50,000, but they also borrowed $5,000 by signing a note payable. So this will be on January 1st. Now the first partner, Smith, is simply contributing cash. In fact, they are contributing $100,000 worth of cash. So I will debit cash because now that money belongs to the partnership. I want to raise the value of cash. And at the same time, I want to establish a capital account for Smith. So we'll debit cash and credit Smith Capital. Now also on the 1st, I'm going to do a journal entry for the other partner. Now it said that that partner was contributing some cash, also a building, they were contributing that, but we have other problems as well. This partner had borrowed money, so that means that we're going to have a liability which must be credited, which is note payable. Because remember, if we're going to take this person on as our business partner, their debts become our debts. We're all in this together. That's one of the factors in a partnership. And then we want to establish for Jones a capital account. So Jones is contributing $10,000 cash, the building which is worth $50,000, but had borrowed $5,000 on a note. So even though Jones is contributing $60,000 in assets, because of that $5,000 liability, their capital really is only worth $55,000. So those two entries are required on the 1st in order to establish the partnership and to establish the capital accounts for each partner. Now, the next transaction is on January the 31st. On that date, we're reporting that the partnership made a net income of $20,000. Now, anytime they have income, that income must be split between the partners. So how are we going to do that? Well, it says that the partnership agreement stipulates Smith will receive 70%, Jones will receive 30%. So this is on January 31st. This is a net income, so we have to close out income summary. That's with a debit. Part of it is going to go to Smith's capital. Part of that is going to go to Jones' capital. Now notice that I'm crediting both capital accounts. Remember, crediting capital increases it. So the total net income that they reported was $20,000. But I've got to split that up on the credit side between the two partners. So that's going to be based on 70-30. So 20,000 times 0.7 means that Smith, their share of 70%, that's 14,000. So that means that the remaining 6,000 goes to Jones. So that's in accordance with the partnership agreement. The next transaction is on February the 1st. Now we have a new partner coming in. It says Owens is going to join the partnership. So we've been successful for the first month. That's, attracting new people. We've got a new partner coming in. They're going to contribute $25,000. And the partnership agreement is now to be amended because now we have to have a new distribution. So from now on, Smith is going to get 50%, Jones 30, Owens 20. That will be the new agreement. But on February the 1st, we're just simply having the new partner join. So on February 1st, the new partner is joining. They're contributing cash. And we need to set up a capital account for Owens. They're contributing $25,000. So the value of their capital will be $25,000. Then we have a transaction on February the 28th. At the end of February, we had made a net income of $15,000. So February 28th, it's the net income. It's a net income of $15,000. We're going to split the item. We're going to split that up into 3 different components. We have 3 different partners. We have Smith Capital. We have Jones Capital. And we have Owens Capital. We have the 3 partners. Now we're going to have to split that up among the 3 partners. And it's going to have to be based upon the partnership agreement. Well, remember that partnership agreement was amended. And it said that now it's 50% Smith, 30% Jones, 20% Owens. So of that $15,000, the 50% that Smith gets is worth $7,500. The 30% that Jones gets is worth $4,500. And so that leaves simply the final $3,000, which will go to Owens. So it's based upon that split, and that split is stipulated in the partnership agreement. The next transaction is on March the 1st. On March the 1st, Jones has actually decided to leave the partnership. And we agreed to accept his resignation, and we're going to pay out to him as he leaves $75,000. So this is on March the 1st. Now, when this person leaves, Jones is going to leave the business. Now, we want to debit Jones Capital. Why do we have to do that? Because we want Jones Capital to be removed. We want the value of his capital to be taken off the books. So that means I have to figure out at this point what is the balance of Jones Capital. I have to know that balance to be able to remove it. So I need to go back and take a look at this. Initially, Jones Capital was worth $55,000. Then we added $6,000 to that, which brought it up to $61,000. Then we added another $4,500, so $61,000 and $4,500 means right now the value of Jones Capital is $65,500. Now notice, and I'm going to skip a couple spaces, down here on cash, we agree to a buyout or a payout as he leaves of $75,000. And like I said, we agreed to that. Whatever we agree to, we have to pay that. So we're going to pay out the $75,000. We're going to remove his capital at its current value of $65,500. Now that doesn't balance. That's a little bit out of balance. What is the difference there? Well, it's the difference between $75,000 and $65,500. That's the difference of $9,500. Well, that difference, if you cut that in half, that's $4,750. Now, why am I cutting that in half? Because the difference there that has to be made up for, that's going to have to be made up out of the other partner's capital. So Smith Capital will go down a little bit, and Owens Capital. So the 2 partners that we have left, we'll take a little bit out of their capital to cover that difference, that discrepancy. Then on March the 30th, now we have a little bit of bad news to report. The partnership lost money this month. This month we lost $10,000. So according to this new partnership agreement, it's now 70% Smith, 30% Owens. Well, this is the first time they've ever lost money, so we have to account for that. Since they're losing money, the value of their capital accounts is not going to go up. It's actually going to go down. And unlike the previous times when we always debited income summary, this time we'll have to credit income summary since it's a loss. So you see how that's a little bit different. And it's a split of 70-30, so that'll be of the 10,000. 7,000 will come from Smith's capital, and 3,000 will come from Owen's capital. And in the final transaction on April the 1st, Smith and Owens have decided to dissolve the partnership and simply take their respective capital balances as a final payout. So this will be on April the 1st. They're going to dissolve the partnership. That means we have to totally eliminate both capital accounts. And the final amount, which is withdrawn, will be withdrawn out of cash. So to finish this out, what we really need to figure out at this point, what would be the value of everyone's capital account? So starting with Smith, I'm going to have to go back and figure that out. Now Smith started out with 100,000. Then we added 14,000. That's 114,000. Then we added another 7,500. So that's 121,500. But then Smith lost 4,750 and lost 7,000. So 121,500 minus 4,750 and minus 7,000 is 109,750. So you see how I have to go back through there simply to figure out the current balance. That's the trickiest part whenever they dissolve the partnership. And then I'll do the same thing for Owens. Now Owens didn't join until this transaction right here. So Owens started out at 25. Then we added 3, which brought it to 28. So that's 28,000 less 4,750 less 3,000. So that's 20,250. That's the current balance of Owens' capital. And then the credit to cash will simply be the total, and the total there is 130,000. That will balance that transaction. So they dissolved the partnership and they simply took out their final capital balance as a final payout of 130,000, and that completes the example on partnerships.